Even in an AI-focused world, MacroEdge is in the business of focusing on you. We don't just understand our clients, we listen to what's said and illuminate on what's not. In a world moving at the speed of light, with shifting markets, evolving workforces, and non-stop disruption, MacroEdge helps you to navigate and identify novel opportunities, expand your enterprise, and succeed in tomorrow's world. And it all starts with you. Put your enterprise and your perspective in the driver's seat. We're in the business of you.
Good evening, everyone, and welcome to MacroEdge Radio number 69. This is John Galt speaking. We have a very special guest tonight. We have a war. We have economic insanity. We have fictional data. We have non-fictional data, and a market that doesn't know what to make of any of it. So what a great opportunity to have Ross Hendricks on with us tonight. We're going to discuss all of this. Crazy as it sounds, we're witnessing history, and we're living through history once again. For those who were around for 2008, that was pretty exhausting. For 2000, 2001, that was very exhausting. For 87, don't ask. And for the late 70s and early 80s, it wasn't the picnic, although everyone thinks it was, but the music and cars were better. Trust me. So without any further ado, Ross Hendricks, at Ross Hendricks on X, at PorterandCompanyResearch.com. Ross, welcome to MacroEdge Radio.
Hey, John. Great to be here. It's I agree with you. I got to say, this has probably been the most exhausting week of that I can remember.
I think that's an understatement.
I know. It was sheer madness. I mean, for me, it started on Saturday morning because I think we got the news. I put out a tweet, not to toot my own horn or anything, but I've been following this this military buildup and going into the Middle East, and we had a video conference at Porter & Co. right, I think the Tuesday or Wednesday going into it, and we had a little discussion about it, and it's like, have we ever seen this much military equipment being moved into an area where there hasn't been a military strike eventually? And I think the answer is no, because you could look through, the buildup that we saw going into it was bigger than, the Desert Storm buildup, basically, or was on par with that. And so, it was a question of when it was going to happen, because it's been building and building for the last few weeks. Reports of massive amounts of, first we had the aircraft carrier news, and then all the transport planes and everything. And it felt like we were getting close. So like the last couple of weekends, I've just been braced, because, one of the things about Trump that we know is he likes to start his wars on the weekends. He likes to get them over quick, and hopefully it's a nice 48-hour clean operation. And I woke up around 4 o'clock in the morning on Saturday, just checked Twitter, just, hey, it could be this weekend, maybe, who knows? And sure enough, there was news that about a couple hours earlier, they had launched the strikes in Iran, and it's been just a nonstop flurry of unbelievable headlines ever since then. Like I was actually a little bit in shock that they actually went ahead with this operation. And the shock just continued throughout this whole week about how unprepared they were for the ramifications and the consequences. And so here we are. I really do feel like what you said, like the world feels like it has changed in the span of a very short week here.
Do you feel as I do, and I've read a lot of your posts and discussions with you online, and for those of you who do not know, on FinTwit, there's a group of us, and this is not a reflection on Russ, that we just geek out over historic events and watching trading patterns and crazy things that occur. And in this particular case, it does seem a large percentage of the market investors and houses were on the wrong side, betting on, one, a quick war, and two, that we knew what the hell we were doing.
Yeah, that second part is key there, I think. You think if you're going to launch a war in Persia, you're going to have some sort of plan for maybe this doesn't, go exactly as we expected. Maybe there's some, a little bit of blowback. There's this shipping choke point that controls 30% of the world's energy supplies. Maybe we should have some, just a few little backup plans in case this gets hairy and it's not a 48-hour in and out operation. But it looks like they had absolutely no plan whatsoever for that kind of uncontrolled escalation that we've seen, it's shocking how unprepared we are for this.
We had a hint of that when one of the Joint Chiefs he was terminated because he disagreed with President Trump and his approach to this and the battle planning that was occurring. And a lot of people ignored that story at the time. It was a red flag to myself, but then again, I'm in precious metals mostly, so I could sit there and say, what a shock, right? These guys don't seem to understand that we're not in Trump version 1.0, and Trump is going to win or burn it all down. So there's a real threat that we still have escalation levels left. And I do not believe that markets have prepared by hedging properly, but also you were talking about it perfectly. The choke point at the Strait of Hormuz, well, everyone forgets aluminum, fertilizer, petrochemicals not related to oil and gas, urea, everything that flows through there that supplies Asia and Europe. And here we are now worrying about Dubai running out of food in 10 days. You have Western Europe freaking out because Russia said, you know what? We're going to give the gas to our friends. Screw you guys. And now there's a sudden awareness that we are not prepared for total war, which includes a resource conflict.
Yeah, that's the biggest thing about this. And I didn't even appreciate how many products flow through that very narrow shipping point that's about at the narrowest point, maybe 30 miles wide. And, it's like you mentioned, there's all these things. It's fertilizer, it's the natural gas. There's countries like South Korea that, they're not like Europe or US where they have these massive underground gas storage facilities. They sort of have built their economy on a just-in-time basis. And I think they've got something like 9 days of LNG reserves on hand. And there's other little products that I didn't even think about, like helium gas is one that I learned about this week, where it's a critical part of the semiconductor manufacturing process where you have to have purified helium gas and there's no substitute for it. And 30% of that comes from a single facility that Qatar runs, this Ras Laffan facility that they produce alongside LNG. And that got hit by drone attacks this week. And it's offline now. And in order to restart that, it's a 1 month lead time. So we're counting down the clock now, not only to get that massive source of LNG, but also helium to keep the semiconductor and the AI boom going. There's just all these little things that people are not factoring in. And I think you're 100% right. I think the markets, energy started to kind of react with a little bit of a delay. I was kind of surprised at the muted reaction on Sunday. And I think the market was still holding out hope that, hey, maybe this is a controlled escalation and it's going to be a short, quick thing and we're not going to quite freak out just yet. But as this week unfolded, you started to finally see some major moves in things like European natural gas and these refined products. And now you're seeing it across the grain futures are rallying because they're pricing in the fertilizer shortage that you mentioned. And, it's just amazing how many countries are going to be screwed. You mentioned Europe. So now there's going to be a fight with Russia. Like, who are they going to send their gas supply to? And then you saw China saying, hey, we're going to start pulling back on exporting diesel and refined products. And it's kind of like over the course of a weekend, without really consulting any of our allies or anybody, we just decided to throw a massive, hand grenade into this single choke point that's really going to have impacts for probably every country around the world. And I can't think of a better way to piss off literally everybody. Nobody is benefiting from this, and it's the number of ways that this could escalate and backfire, not just in Iran, but in terms of how we're going to be looked at by our allies and even our foes, and how this is all going to, what the struggle is going to be as these resources become in short supply. It's just the number of ways this could go wrong are basically endless, and it's very hard to see how there's any kind of a positive resolution here.
Well, let's move on from that to the economic impacts that we're seeing and witnessing currently. I do my usual drive to work to the office. I look at the numbers and I see diesel at 4.79, something not taken into account for by the president. I see unleaded at 3.49 locally. And you have to start wondering why people seem to think that an increase in diesel prices, and this is what the administration was out today pushing, that these price increases in diesel and unleaded gas are not inflationary. It's the most insane thing I've ever heard in my life, because trains use diesel, tractors use diesel, semis use diesel. So please, someone fill me in on this. I want to hear this new economic theory, Ross, if you've got anything.
Yeah, I mean, that idea makes about as much sense as that the idea that they floated out about they're going to intervene in the crude oil futures market and somehow force the price down artificially by short selling crude oil futures. I mean, this administration is just in total denial across the board, whether the impact of the war, the blowback effects from that, or the economic ramifications. They have no plan. They're not prepared, and I think they're in denial about what this is all, all the different ways. Inflation is going to be the big one, because I mean, energy alone is a big enough crisis. And if you just look back over the history, going back to our nerding out on historical patterns in the financial markets, if you look at every bear market in the last, really since the 70s, they've all been preceded by a spike in energy prices. So you go, 2022 was our most recent bear market. That was preceded by the doubling in oil prices. Same thing in 2011, you had that major spike in energy coming out of the GFC that partially catalyzed the European debt crisis. 2008, you had the run up to record highs. And even in the lead up to the dot-com bust, you saw the same thing. Crude oil went from 12 to 40, and that was, the peak of the dot-com bubble. And if to ignore the impact that energy has on the economy and how that is a direct tax on the consumer, it's hard to fathom how anyone could sit there and say that this is not going to have an impact. And especially right now, when we're the number one thing on the public's mind and the number one complaint is this affordability crisis. And we are, after 4 or 5 years of post-COVID inflation, it's the last thing anybody needs is to see their energy bills go up, see the price at the pump go up. And I think it's happening at a very fragile time where there's just not that buffering capacity, and the 90% of consumers who are just barely hanging on, the ones that don't have exposure to the stock market, that are living paycheck to paycheck, this is going to be a big problem for, the majority of people out there.
And this is where it starts to escalate higher and faster. You had a very good retweet you posted from Scary Lawyer Guy. The minute I read the sentence that was posted, the Trump administration, this is from an article, by the way, boys and girls, the Trump administration did not start hitting the phones to discuss ways to calm oil and gas markets until several days after the attack started and oil prices started rising. So basically the plan is there was no plan, and you highlighted that. And we're now at a point where we're reactive to market actions. And when that's the case historically, a political reaction to a market event and to a supply squeeze usually has poor results, especially since we already had Bessent come out today and Hassett rule out tapping the SPR, which has never been restored from the Biden drain. So we really don't have the refining capacity nor the excess energy stores to begin to try to put pressure on the markets. We're going to let the markets dictate a political reaction. And that usually works out pretty poorly in markets.
Yeah. Every time historically that politicians have gone to war with the market, their track record is unblemished by success. So it's very obvious that they have no plan. I think it just goes back to they did not foresee this level of response from Iran, and so they have not mapped out any kind of scenario response. And as you mentioned, the biggest problem we have is the SPR was drained under Biden, and we never took the time or wanted to spend the money or whatever. Whoever made the decision, nobody wanted to fill it back up, and so here we are it's about half of its prior. 2022 was the peak level, and we're about half of where we were at that point. And we just have, everyone talks about America is energy independent, but that's not really true. We produce about 13 million barrels a day of oil. We consume 20 million barrels, but we also export refined products. But the main thing is that it's a global market, and every day U.S. refiners and producers, they have the ability to sell to the highest bidder. And so if you have a shortage in some part of the world and prices go up and there's a shortage, that oil is going to start getting bid to pushed around to the highest bidder. And that's going to, it's a global market. So we will feel those prices. And my concern is that we're going to start to see things, we're already seeing it, mentioned earlier, where China's restricting exports, Russia's starting to restrict who they're sending their gas to. If we get into a really dire situation, it's possible that the U.S. begins restricting exports, and then you're going to have a whole new dimension to this trade war thing that could get pretty dicey if countries around the world start hoarding resources and trade breaks down. And that's just one of the ways that this could really go haywire.
That's interesting because we do have a situation developing with China as we speak, where President Trump is betting his entire second term, basically, in the midterm elections, on a deal with China to sell them 500 Boeing aircraft to solidify the rare earths deal, et cetera. But in reality, China is going to hold that energy axe pretty heavy over his head if there is any paring back of energy exports to China from the United States. I believe, in my opinion, the rare earth and purchase of American manufactured goods comes back to the table again and puts us back in the very same bind, which is why we have weapons shortages, the lack of rare earth processed metals, period. I don't know how we're going to get out of this trap.
Yeah, that's, and it's interesting when you look at the sequence of events, how things started in Venezuela, which happens to be one of the major, they sell most, or before the invasion or the kidnapping that we did to Maduro there, China was the main buyer of Venezuelan crude. And then we went straight from there to Iran, where China gets another major source of crude from that Iran, and also, all the energy that flows through Hormuz. And there's some theories floating around out there. This is part of some grand strategy to gain control over China's energy supplies so that we have a better bargaining chip to combat that rare earth problem. But again, that's a dangerous way to go to head to head with China over energy, and rare earth metals are arguably the two most critical resources in this global economy that we have. And I don't think they're going to be very pleased to negotiate if it comes down to we're going to control energy and use that as a bargaining chip for rare earths. That just feels like a very aggressive way to do diplomacy. If that's part of the plan, I don't know if it is or not. Maybe there is no plan there. But I think it is interesting that we went straight from Venezuela to Iran, and it happens to be that's a major source, both of those countries, of China's energy supply.
And it does appear we're making preparations for Cuba, so why not just sit there and go and open up a three-front war?
Right.
It's fascinating. It's ridiculous.
Yeah, we're having so much success in Iran right now. Why not open another whole new campaign while we're at it?
Yeah, let's not do that when I'm on a plane to the Caribbean soon. I really would like to get this vacation in. So let's move a little bit to the bigger macro picture. The data today was about as stagflationary as one could expect or believe. Massive revisions to the unemployment data. We have U3 non-seasonally adjusted at 4.7%. Everyone likes to quote the TV version. I like the hard data. U6 at 8.3%. And we're watching a deterioration in the duration of unemployment, with 15 weeks and over at 41.1% of all unemployed. This is not a strong economy by any stretch or measure.
No.
We're starting to see the legs kicked out of the chair for the poor middle class and lower class.
Yeah, and that's what makes this particularly concerning is, if you had a strong, I think back to the invasion of Iraq in 2003, and that occurred at a time when the economy had already been washed out. You were you'd already worked through a pretty long bear market, a devastating bear market, really. The recession wasn't actually that bad, but we were on the tail end of a downturn, and we were just coming out into an expansion at that point. And we didn't have any major energy disruptions except for Iraq's production dropped by a couple million barrels, I believe, at the start of the invasion, and took a long time to recover. But you did have that big energy rally that started in '03, and it didn't impact the economy because we were coming into a brand new cycle at that time, and so we had a lot of buffer capacity to deal with the inflation that occurred throughout the 2000s, and it didn't really come to a head until '08. Like we mentioned, we had that big oil spike at the very tail end of things. But right now, we're in the opposite scenario. We're at the tail end of an economic expansion. The labor market's really been deteriorating throughout all of last year. If you look at the revisions, and that was the other interesting thing, is that the revisions just continue to come in month after month, just worse and worse on the historical numbers. And so all of the headline reports that looked relatively okay at the time in real time throughout last year were actually pretty awful. And now we're even seeing it, as you just mentioned, the actual headline numbers are starting to really deteriorate, which is a really bad sign, because what's most likely going to happen is the revisions, when you get into these revision cycles, it becomes a trend. And so if we're in a negative revision cycle, it probably means that, historically speaking, the next few months will be revised down as well. And to have this kind of a shock at a time when the economy is this weak and we're this late cycle, and we've already had this incredible mania in the tech stocks and the AI boom, to me, it feels like we are primed for the very last thing we needed at this point in the cycle was a major inflationary outbreak. And given how weak the consumer is, we're already seeing a lot of signs of just weak consumer spending trends, and they're maxing out credit cards and buy now, pay later, because the employment picture is so weak and the incomes aren't there. It's just you hit an economy that's already this weak and vulnerable with an external shock like this, and I think it's not going to be a good look.
But when you say that, you look at the not good look, but everyone's looking at the top 5-10% of income earners. But I'm going to throw a story out to you because I think that these are distorted numbers in some regards. This is a New York Post story. It's common. It was circulated widely at the time back in February. Nobody paid attention to it, but this mirage of wealth. The story was headlined, "Home equity is helping retirees as savings fall short." Well, right now we're seeing massive sequential declines in home prices and valuations, especially here at Ground Zero in Florida and in Texas and in Arizona and on down the list. If we're seeing a squeeze on the home equity, does that not highlight the myth that there is this big wealth boom? And if the other leg gets kicked out, the stock market, by a what I would consider normal 10 to 20% correction, that would pretty much be doom, except for the ultra rich and those who are prepared for this kind of occasion. Am I incorrect in my assumption?
No, that's exactly right. I think that's been the story of this economy for the last few years. I mean, we all know that the average person out there, anyone who doesn't have a huge net worth exposed to rising asset prices, has been struggling. I mean, we see it, you can feel it. It's in the data, but you also see it in the consumer surveys, and the political exit polls are showing this affordability crisis. I mean, that was the big thing that we took away from this last election cycle, was that people are very, very tapped out, basically. And so that is a big concern. If we get to a point where that top 10% that's been riding high and kind of carrying the entire economy on its back through this, I think we've all seen those statistics where I think the top 10% is now a record share of consumption. It's over 50% for the first time ever. That's the real vulnerability here, is if you get into a cycle where these asset prices finally deflate, that is what could really kick into a self-reinforcing downward spiral you see in every recession, where asset prices come down. That's a negative wealth effect. That's less spending, less corporate earnings, lower stock prices, and it's just this reinforcing downward spiral until you finally bottom out at the depths of a recession and a bear market. And I think you're spot on. I mean, home prices have peaked out. and that's going to be a problem for people tapping home equity. And really, the last leg of this stool is the stock market. And this week in particular, it's interesting. The market really, and if it depends on which index you're looking at, but if you look at the S&P or the NASDAQ, I mean, they haven't done anything since late October. It's been this sort of grinding. It feels very distributive, where every time you try to get to a new high, you just met with this wall of selling and you just cannot break through to the upside. And to me, I think this week was surprising that we didn't see more downside pressure in the stock market, but we did end on a pretty negative note. And I think this today's spike in energy, I think, really caught a lot of people like, hey, this is a real actual a supply shock here that we have to start thinking about. And that's why I think we're at a really pivotal point right now, where if this energy spike continues and you see more price action like we saw today, closing on the lows, and we finally break down out of this very choppy sideways range we've been stuck in for 3 or 4 months, I think that's going to be the key that really kicks us off into a down cycle in the economy. Is if you finally lose the stock market and you lose that wealth effect of the one component of the economy that's been holding everything up.
I'm going to go a step further here with what's been going on as far as credit, because we've also read the stories. You've talked about it. I've talked about it. The restrictions being imposed on, I hate using this phrase, but it's our mocking phrase for the CNBC crowd, the poor's losing access to credit, to easy credit. And no one seems to highlight this, but the lower 50% was already struggling. And that's including retirees, folks. Not every retiree is a millionaire, believe it or not, living in a McMansion. And the lack of access to credit is also going to be a major impediment, not just for stock market prices to advance, but any kind of economic growth in the future. And now you're adding an inflationary supply shock or stagflationary. It doesn't seem to be a formula for equities to really boom or have a normal cycle top. I think the top is in for the markets, but we'll see.
Yeah, I'm with you. I think the top is in as well, and that credit component is really important, because that is how the lower class really, and not the lower class, really everyone up to the 80, 90 percentile. That's how they've been dealing with this affordability crisis, and the fact that wages are not keeping pace with inflation, is they've been using credit to plug that hole. And it's not just the credit cards, which are you're losing access to those, and that's a big problem. But it's also the buy now, pay later, which has become a real force in this economy, and a sort of shadow credit statistic. They're getting a little bit better at starting to aggregate that data and factor it into things like your credit reports and credit scores. But it's still a little bit. It's in the shadows, and you can easily make these purchases by signing up to any site you go to nowadays. Feels like they have these buy now, pay later programs, and it's sort of this phantom credit that's out there. And I think once that starts to go away, and that's going to be the same cyclical, when you start to see the credit card companies pulling back on extending credit, you're going to see that same thing with the buy now, pay later companies. It's really, they're pulling back because they're seeing rising delinquencies, and they're starting to actually take losses on these loans, and that should all be very correlated with one another. So if we're seeing it in the traditional credit cards, I'm sure it's happening in buy now, pay later. And if you lose that ability to plug your lackluster income by borrowing all this money to keep your consumption up, then yeah, that's going to be a big hit to consumption and a big hit to economic growth.
We're going to take a quick pause because I want Ross, and we do this for all our guests, folks. We want you to promote your website, your product, and your input on X. Please tell everyone who's listening where they can find you and what products you're offering for actual premium market analysis.
Yeah, so I work for a company called Porter & Co. We are a boutique research service. We have all kinds of different products that we offer. The one that I focus on is called the Trading Club, where we are managing an actual live portfolio, and I'm giving you real-time trade alerts. Usually, a couple times a week. Sometimes we have no trades. Sometimes we have a lot. but it's basically we're in the trenches with you, and we're tracking a live portfolio and showing you every step that we're making along the way. And we launched it last year. We're up 30% so far, and I think that's about double the market. And so we open it up once a quarter, and we are actually about to open it back up for new subscribers starting at the end of this month. So if anybody's interested and wants to check it out, just send me a DM on Twitter, and I can work with you and give you some sample research and see if we can get you hooked up with a subscription.
Thank you so much, sir. And remember, follow him at Ross_Hendricks on X. You cannot miss it. If you see him and I going at it about the economy, you can expect him to sit there and spit fire. I'll spit snark. It works great. We have great discussions, though. We really do get sick and tired of the false pretenses being pushed forward. And it's because numbers can lie, but the real numbers eventually come out. I think that's what you were discussing with the revisions. They do come out of the wash. And when they hit, it hits the markets a lot harder than most people think.
Yeah, today was a great example of that. I was surprised at how negative when in the early morning futures trading, we were down almost 2% on the NASDAQ early morning off that payrolls report. And that's a kind of a unique feature because we've been having relatively weak payrolls. I mean, this one was particularly weak, and I think that's why you got that outsized reaction. And yeah, it's, to me, the market's finally starting to wake up, and I think starting to show some concern that this is not a temporary one-off weak labor report. It's starting to become a trend that's becoming, it's accelerating to the downside. And yeah, when you start to see market reactions like what we had today, it's telling me that people are starting to pay attention and take note, I think.
So I think a lot of portfolios are getting hit. I'm going to hit some stocks real quick, if you don't mind. And if you can't talk about them, I understand. But I'm looking at year-to-date, folks. And year-to-date, the reason I'm only looking at the first quarter, we're heading into a quadruple witching on the 20th. And if you don't know what that means, Google is your friend. It will explain why this is an important week. If we have $100 oil and stocks like CoreWeave down 35% from its peak in January, Amazon down 14%. Since the February high, NVIDIA down 10% since the February high and report. The SOX down 12%, for God's sake, since the February high. And you start looking at those are the core of what was supporting it. Speculative semis, big semis, the Mag 7, and they're getting smoked. And these liquidations that you and I are watching, tell me if I'm crazy, tell me if I'm misreading my charts. But it sure as hell looks like widespread distribution by institutions to me.
No, that's right. And I've seen it in my own portfolio too. I've sort of been trying to play a little bit of defense with the few stocks that I am long. So I've been, in names like Philip Morris and British American Tobacco, stocks that, they should be immune from the economic cycle. They're trading at, they were trading at reasonable valuations. They have both had, the staples in particular have had, you kind of saw this panic bid into the whole sector as sort of a flight to safety earlier this year. But now what was really caught my eye this past week was that even the staples got hammered. I mean, Philip Morris had one of its most vicious sell-offs. I mean, this is a stock that you don't see it really have that kind of a multi-day, what are we down, over 10% in, the span of 5 or 6 trading days. And I've watched this stock for years. I've owned it for years, and I pay a lot of attention to what it's doing on a daily basis. And there's not a lot of action in that name, but to see it sell off in that kind of just pure liquidation fashion, and it's across the board, whether it's, the Pepsis or the Johnsons and Johnsons, and even some of the, you take a look at like a Caterpillar, a lot of these AI winners that were just huge momentum winners, you're just seeing it across the board. And it does feel like you said, it's just a liquidation and a de-risking. And those are usually, when you see that kind of widespread, and it's even precious metals too. I mean, that was supposed to be the safety trade. And you would think on a major escalation of inflation, war, I mean, you've got the perfect story to tell for precious metals right now, but they have also been selling off pretty hard. And I think it is indicative of, we're just seeing widespread, deleveraging, people selling anything that they can, just raising cash. Doesn't matter what it is, they're just selling across the board. And that's a worrying signal because you usually see that before a big move when there's just a lot of pain out there and people are under pressure in their portfolios, kind of across the board.
Well, look, I took my beating on precious metals. I sold most of my equities back during the first peak, because juniors are notoriously profitable, but also volatile. And I got out. Then there was a big crash in precious metals. But I'm seeing a lot of these major gold miners, major silver miners, gold and silver slams. It does seem like there's a lot of that being sold for margin call to keep their Mag 7 stocks, to hold on to their big cap tech. And at some point, you just got to say, I give up and walk away from it. Am I right?
Yeah, it's funny that I feel like we've been in this market for so long where there's been such an aversion to just go to cash. And every time one sector gets sold, the money flows straight into another sector. So like you mentioned, we're seeing these rotations from things that have nothing to do with each other, but people are just looking for the next safe trade, whether it's, like earlier this year, we had the Staples rally and then gold, and then it goes from gold to Mag 7 and back and forth. And then the energy stocks were really hot. That was another thing that was interesting this week is that you've got crude oil, one of its biggest weekly gains ever, and energy stocks either were, lackluster, flat, or even some of them were down on the week. And I think when you have a market like that where I think it's one of those markets where it's just nobody wants to go to cash. Everybody wants to have some kind of risk on the table. And it's just this constant rotation. But at a certain point, when you do get into an actual downturn like we saw in 2008, just everything gets sold. It doesn't matter whether it's the world's best consumer staple stock, whether it's a Walmart or the most indefensible high quality consumer staple, or it's precious metals. Everything gets sold because eventually there's, like you said, the margin calls and it's just forced liquidation. And I feel like we're just starting to see the very early signs of that this week with just this weird price action where everything is sort of, there's really no place to hide out in this market. And to me, that's a big warning sign.
Well, that brings us to the news of the day. And before I go to that, macroedge.net/ozone, macroedge.net/ozone. Get your free trial. See all the exciting developments from MacroEdge. We're doing a lot. Things are changing fast, just like what's going on with Ross and his trading company and his research company. Everyone is having to evolve on the fly right now to grow into whatever the outcome will be for this economy. And this war is going to change a lot of things and a lot of opinions. And we are going to be in a new multipolar world when this is over with. Take my word for it. Stay ahead. Get the research from alternate sources. Don't just depend on the idiot box. That being said, the news of the day from BlackRock was shocking. And what is your opinion of that this morning, that they're gating one of their funds? I couldn't believe it myself.
Yeah, well, that followed the other. It wasn't shocking, but it was a funny one earlier this week where they, we've had several of these just implosions in private credit where the loans marked at 100 cents on the dollar 1 month, and the next month, oh, sorry, never mind, it's a zero actually, total loss. And they reported one of those. It was a small loan, but it was either earlier this week or late last week. I forget. My days are running together at this point. But I just found the timing of that was interesting, where when you see something like that, where a loan goes from 100 to zero over the span of a couple of months, what it's really telling you is that the 100 was the wrong number. They have these asset valuations that are mismarked. And the interesting thing about private credit is you can keep that charade going as long as no one's asking questions. And most importantly, if no one's asking for their money back, because if I give you $100 and you say, hey, I'm going to go invest in this property or whatever, and I'm going to report back to you every month what your investment value is, and we'll go along for a couple of years and you'll tell me, hey, it's at 100, it's at 105, 110, whatever. Or if it's a loan, it's just, money good at 100. And then all of a sudden they say, hey, John, you know what? I've got some other things I want to do with the money. Can I get that loan back? I'm going to redeploy it, whatever. I've got personal expenses. And you say, oh, sure, no problem. Let me get that for you. And all of a sudden it's not $100, it's zero. You took a total loss on the loan. I mean, that's that's when the rubber comes to the rubber hits the road in terms of you have to accurately mark these loans because you have to give someone a certain dollar amount return from what they gave you. And so that's why I think it's not a coincidence that they're starting to mark these loans just as you're getting this wave of redemptions, and they're slow rolling this out. But of course, the issue becomes if you are way underwater across an entire loan book, and if you have a flood of redemptions coming in and you have to monetize an underwater loan book, that's an ugly scenario, especially for the world's biggest private credit fund. I mean, you could be talking about billions of dollars of money just evaporating overnight. So, if you don't want to do that, your other alternative is to gate the fund and say, hey, we got to process these requests. We don't have the liquidity. Give us some time, whatever. And that'll give you some, road to kind of try to string things along and not take as big of a hit all at once. But it's a major red flag when they start putting the gates up. I mean, that's exactly what you saw in 2007, 2008, leading up to the mortgage crisis, when you had a lot of those subprime hedge funds start blowing up, and they started gating withdrawals. But obviously that just delays the inevitable. It never fixes anything. And that this private credit industry has become so large, it kind of filled in for the traditional lending sector coming out of '08, because all of the regulators really cracked down on the traditional banking system in terms of how risky, how much risk they could take in extending credit. And so private credit is unregulated, and it's, there's looser rules with what you can do. And they went out and took a whole bunch of risk and gathered a whole bunch of capital. And, historically, anytime you see a sector of the financial system grow very fast, very quickly, with loose oversight, you get a lot of losses eventually. And I think we're finally at that point where these losses are becoming crystallized. And that's why they're having to gate these withdrawals. And that's going to be another big shoe to drop at some point here.
Well, it's funny you bring up 2007, because I've got a Fitch story via Reuters. Private credit defaults hit 9.2%. I'm beginning to wonder if part of the consequence to all this, what we do not see are the protection instruments being cashed in, the CDS, et cetera. I wonder if they're going to pay out to private credit, because you and I both know they're using private rating agencies to create these mythical AA, single A plus ratings for their private credit instruments and justify the ridiculously low yields they've been paying. I mean, 7% on something that should be a triple B and it's getting an A plus. Come on. You and I both know that's just insane. So if this happens, it's going to happen just like 2007. And I'm going to hit some more stocks real quick for you to bring into this discussion, because this ties into what you said. Year to date again, Goldman Sachs down 16% from the high, Citigroup down 15%, JP Morgan 14%, Morgan Stanley 16%, and the KRE, which deserves to be down more, down 13%. I think it's starting to hit the banking sector, and I don't think Wall Street's ready.
Yeah, it is. That's another worrying sign, just in terms of the technicals of this market, is seeing such a breakdown across it. Like you mentioned, it's across the board. It's the big banks, it's the small banks, the regionals, the private lenders. That's a big concerning sign. Usually, for a healthy bull market, the financials have to be right up there with the leaders, and they were as recently as late last year, early this year. And that was one of the things that gave me a lot of reservations about trying to short this market, was seeing the strength in things like the XLF making new record highs as recently as January. But you have really seen a pretty dramatic reversal across that sector. And that, to me, that's another huge warning sign for the health of this bull market.
I concur totally, and I believe that we're just beginning to see the fringes of this, yet we don't seem to have any visibility on the spread to the insurance companies, who, for some strange reason, many states allowed to dabble and play in the private credit markets. And once again, you highlighted the mortgage-backed securities, the reintroduction of the subprime mortgage fun and games again to lower or less qualified, or probably should have been qualified, buyers in many markets. It seems that we've repackaged the same mistakes, but promised with pinky promises we won't do it again.
It really is amazing how we really learn nothing. I mean, it's whether it's the rating agencies you just mentioned or the loose oversight in terms of allowing, regulated insurance companies to buy these higher risk loans. It's kind of like that nature finds a way saying, where like if there's a vacuum in the market where these companies, they need the high yield, but you can't get it from the traditional lending system, the spreads are too low, then of course something will pop up to fill that vacuum. And private credit was the thing that propped up to go make these high risk loans and promise higher yields. And they worked the regulations so that various institutions like insurance companies could buy this stuff. But yeah, it's the same mistakes over and over again. You go find some subpar ratings agencies that'll rubber stamp the stuff. You get the lawmakers to make new rules that you can package it up and buy it and sell it. And it's the same story over and over again, and it's probably going to have the same ending. It's my bet.
Yeah, that's the disturbing part. We see a 10-20% decline in housing prices in Florida. That's the norm. Every time we bust down here, it's 30 to 40%, and we say, okay, let's go out and speculate some more and rebuild it up for 10 more years. The United States doesn't seem to understand that everything we're witnessing has happened 16 years ago, 30 years ago, 50 years ago, and we don't seem to take into account or learn a lesson from it. And now the United States is acquiring gold from Venezuela. We don't peg the dollar to gold, so please, what's the point of that?
That is a good question. I saw that headline this week in the flurry of other chaotic headlines, and it puzzled me. I was like, where does that? I'm sure there's some nefarious activity going on, but I had that same thought. Like, that's a strange kind of headline to see flashing across your screen, and I couldn't quite make sense of it. I mean, I didn't spend a lot of time thinking about it, but it was strange that at the same time we're having this geopolitical escalation and the start of resource wars around the globe, that all of a sudden there's this sort of under the radar, no one much talked about it, a few headlines here and there, this massive shipment of gold from Venezuela to the US. I'm sure there's somebody out there that has a nice, fun conspiracy theory about it, or maybe someone knows. I would love to find out what the story behind that was, but I was equally puzzled when I saw that cross my screen this week.
I had a brief chat with Luke Groman online. I sat there and said, if we were to reintroduce even a partial peg to gold, the deflationary impacts would be so dramatic. I don't think anybody in our society would be ready for what would occur with any kind of repegging to gold, even if we made gold $10,000 an ounce, if it's held by the government. So it's one of those crazy headlines, like you said, that you really can't anticipate. And now we've got two new headlines tonight. I'm just going to fill you in because I know we've been doing the program together. While the Jerry Ford is trying to sneak through the Red Sea as we speak, good luck, guys. A third carrier strike group is the H.W. Bush is preparing to deploy. So it looks like we are, in fact, as was stated in the news flash while we've been on the air, that they're preparing for a 6-month or longer duration conflict, up to and including the deployment of ground troops.
That last part.
Yeah, go ahead, sir. Go ahead.
That last part is the one that worries me the most. Is the boots on the ground in Iran. I mean, I can't think of a worse idea, honestly, out of all the horrible things that have been done in this country. I mean, even Bush wasn't crazy enough to go into Iran. I mean, I think he knew better, even though it was part of that list of 7 countries that they began mapping out in the early 2000s. That's going to be the it's a country. First of all, I mean, we had enough trouble in Iraq, as we all know. Iran's 4 times the size. It is, what we learned this week is it's perfectly embedded within striking distance of the largest concentration of energy and shipping, infrastructure in the world, so they can wreak a lot of havoc that way. And the other problem is it's incredibly mountainous terrain where you are just a it's going to be a hand-to-hand type of, not literal, but to try to go in there and root out every bad guy in that country if we really get into a full-on, conflict in terms of boots on the ground invasion. I just think we're walking into an epic trap if we end up doing that. But I think the reason why we have to, that's the problem, is when Trump kicked this thing off and had no backup plan for, hey, what if the Iranians start to really punch us back and cause a lot of problems for us and fire off enough of their missile supply that we degrade our anti-missile defense capabilities, which is what they've basically done. Trump has no option at this point. And I think I think the boots on the ground is the last resort, because once these carrier strike groups run out of missile defense and you run them down in Israel and all of our bases around and our allies in the area, the whole region becomes a sitting duck, and Iran's going to have free reign to launch $2,000 drones and take out billion-dollar pieces of infrastructure, or God forbid they start taking out Navy ships because we just don't have the defensive missile capability. I mean, those things are very hard to reproduce, very slow, and once they're gone, they're basically gone. And so I think this push to get more aircraft carriers in the region is sort of the stopgap, but I think he's going to have no choice but to go boots on the ground, because if you can't defend your assets in the region with anti-missile capabilities, then that's your last resort, basically, is to go full-on boots on the ground invasion. And I think it's going to be the biggest mistake that Trump ever makes, is my prediction.
I'm not going to disagree. And Ross, I'm going to take a minute and highlight my historical background on this, folks. For those who are not familiar, and Ross is a lot younger than I am, trust me. The studies of the Iran-Iraq War are one of the most fascinating and understudied periods of Middle Eastern conflict. And for those who are not aware of how radicalized the Iranian people can become, it's an attack on the Persian history and culture, not just the Shiite religion. So when you interlock those two, you end up with situations which horrified the Iraqis, including the Republican Guard, where 12-year-old girls were locked arm in arms, singing religious songs in praise to the Ayatollah, clearing minefields. In the middle of a pitched artillery battle, being mowed down by the hundreds and thousands. Folks, these are not people. This is like fighting the North Vietnamese. This is a different cat. And using rationalized concepts of Western warfare do not apply in this situation. Yes, we can bomb them back into the Stone Age, but can we afford a negative GDP for 6 quarters? Can we afford the cost of putting boots on the ground? The answer is obviously no. And that's what scares the living crap out of me. Please, Ross, feel free to comment.
Yeah, no, I it's interesting to hear about some of the history. That's probably something I should be studying up on, and everybody should be right now. But I just know from the textbooks that any country that's tried to invade Persia, it's been a disaster across the board. And I know that the reason we haven't tried this so far is because it is the hardest, target in the Middle East in terms of just the geographical advantage alone that they have with the mountainous terrain and the ability. I mean, they have, from what I understand, they've basically blanketed the coastline with all kinds of missile and drone capabilities. And it's funny, the Iraqi foreign minister, speaking of like how kind of radicalized and, we've kind of kicked the hornet's nest with this. I think the thing that really sealed our fate here with this latest invasion is twice in a row now, we have been engaged in negotiations that we gave the impression that were going well, everything was smooth, and we took a break over the weekend, and we're going to continue negotiations on a Monday. And this is back in the June before the 12-day war. And the U.S. and Israeli woke up on a Saturday and started bombing the country in the middle of this negotiation process. So that was the first thing we did. And then we did it again this last time. We were in the middle of negotiations going into last weekend. We had a meeting scheduled for Monday, and there was reports that talks were going well, things were looking up. And we bombed the Ayatollah, his daughter and granddaughter, in their house. And I think that was what crossed the line. So I don't think these people are going to want to negotiate with us. And I think there is a hardcore radical element in that society that we have just awoken with our actions. And so now you're seeing, they had an interview with this foreign minister, Aragachi, and the topic was like, all right, so what about a ceasefire? Was there any potential there? And the guy was basically like, no, we're not interested in the ceasefire. And as a matter of fact, we're waiting for the ground invasion. Like we know it's coming and we're prepared and we're looking forward to it. And I really think we've ticked the hornet's nest here. And yeah, like you said, you know the history of this culture and these people. And I just, it's really scary to think about how disastrously wrong this could go if you just look at the history of what we've tried to do in the Middle East, whether it's Iraq, Afghanistan, and how many troops are we even going to be able to physically move over there in any reasonable amount of time? That's the other thing, is it takes a long time to move 100,000 troops across the ocean. And are we going to try some limited airdrop? And how's that going to go, invading a country of 90 million people with are we going to have the same lackluster planning with that type of invasion that we had with this latest invasion that started last weekend? I mean, you could really see things go pear-shaped very fast in any number of ways.
Okay, and that brings us back to ground zero, the American economy. We've talked throughout this hour about everything with the impacts of oil prices, equity markets becoming very shaky, credit, the fraud-based economy, and private equity and private capital. And now here we come to the point where we do the big question. And my big question for you, we have three aspects. One, you brought it up so eloquently about the negotiations. With that and how the trade negotiations have been conducted, what nation would ever honor or follow through on the memorandums of understanding? Number two, you have the Customs and Border Patrol telling the United States court system, the Court of International Trade, and people, whether it's the average schmuck like me who's imported stuff, or FedEx or any other forwarder, we're not refunding you taxes. We're going to steal your money. Why would anyone negotiate with these folks? So that brings us to the real risk. Are we on a course for stagflation, then deflation, leading to an economic contraction that goes and spirals out of control, as the one thing that's always underpinned the American economy was a rule of law and order and trust in your business partner? Are we at that point of risk where we could lose it all to try to maintain this illusion of fraud and success that's been promoted?
That's such a good point, because that's the one thing I've been thinking a lot about this week, is just how we've been conducting ourselves as a country, whether it's with the trade negotiations going back and forth and strong arming people, and whether the negotiations with Iran, where we're pretending things are going well and then we surprise bomb you not once but twice. And I think we're losing a lot of credibility. And then I think the real big thing to me, the real pact that is, I think, a huge risk for America is, if you think about the petrodollar system itself, that was a pact where we agreed to basically provide military protection and an umbrella of protection across the entire Middle East and really around the world. But the Middle East is where it's showing its phrase, where we let these countries allow us to come in and build massive military bases in their country. And in exchange for that, becoming the policeman of the world, we're basically your protection. If anything goes wrong in the Middle East, you can count on America. Except this last week really cast a lot of doubt into our ability to provide that protection with this ill-planned escalation in Iran that no one in the region wanted. I mean, this reports that a lot of these Gulf states were lobbying aggressively for us not to do this because they knew how bad things could get. And it turns out things got pretty bad. And when their missile stockpiles are running low, it's like, oh, we're not going to actually be able to refill those. And instead, we're going to have to, pull resources over to protect our assets or to protect Israel's, because they're getting, hit across all their cities and devastation. But you're taking protection away from these longtime allies that are really, whether it's Qatar, or UAE, or Saudi Arabia. I mean, these are the pillars of what allowed this petrodollar system to thrive. And if they're now saying like, well, wait a second, all this time we thought we had this umbrella protection of anything ever goes wrong in the region, the United States is there to back us up. Well, that's just been shattered in the course of the last week. I mean, in a huge, huge way. You've got, Qatar's biggest LNG terminal down and out. And as you mentioned earlier, countries like Dubai, they could be running out of food in 10 days. And so I think we've really we've taken about a week to destroy decades of these relationships and partnerships and understandings with things like the petrodollar system. And I think the real tail risk of the resolution of all this is that whole thing gets wiped away. I mean, we could be out of the Middle East completely by the time this war's over. And the petrodollar system could be completely wiped away. And that's a scary thought, because that's when we lose our ability to issue cheap debt and currency around the world in exchange for importing all these goods and services. And we have to balance the budget overnight. And that's when you could get a real crisis. That's, I think, at some point down the road, that's the real risk that America faces. And I think this last week brought us a lot closer to that end game.
I think you're correct, and I think the problem that most people don't understand is stagflation is considered so 1970s, but deflation is something that I would say, unless you were around like old guys like me in 1981, this society has never experienced it.
Yeah.
And that is terrifying.
Yeah, I remember my parents talking about how brutal the recession was of '82. That was in a lot of ways worse than the 1970s, because deflation, you've got job losses, no income, interest rates are high, and the economy just really kind of ground to a halt. Whereas in the stagflationary 1970s, you had jobs and you had money flowing around. It was just the prices were running ahead of incomes. But when you lose deflation, it's a whole other beast, where things just kind of grind to a halt, and you go from your income not keeping up with inflation to having no income at all. And if you have any kind of debts, they just become a crushing weight. And that's kind of what causes most the deflation across the whole economy, is that the weight of the debt becomes unmanageable. And that really is, I think, the end game for America, is at some point we're going to have to deal with this debt problem. And you really have two choices. There's the deflation, which is very painful, or you have the hyperinflation road, which is a whole nother disaster. And I hope we never go down that road, but I don't know. It feels like we're in a world where anything is possible. Just the scary part.
That is terrifying. Please, sir, promote Porter and Company Research one more time.
Yep. So if anybody would like to find out about the research that we do and the trading strategies that I provide and update and track with a real money portfolio every day, send me a DM through Twitter, and I can get you in touch and see if we can get you a subscription. And you can also visit our website at Porter and Company Research.
Ross, this has been a pleasure. Don't be a stranger. And hook up with the MacroEdge team anytime. You're more than welcome, sir.
Yeah, it's been great. I appreciate it. And get rested for another crazy week. I have a feeling it's not going to get any less crazy next week.
I agree. I think quad witching is going to be something else. I'm going to end the show with a personal note. Number one, macroedge.net/ozone, macroedge.net/ozone. Thank you again to our guests. Folks, I want to thank you for all the well wishes. The surgery was a success. No big deal. I'm fine. My voice has changed a little, but it'll grow back. I'll just have a cigar to get the raspiness back. There's one story that I didn't cover with Ross, and I held it out because I'm tired of hearing how the golden age is going on. It's an NBC News story. It got no coverage on a widespread basis for February 12th. I haven't had a chance to talk about it, but let me just give you the headline to show you how bad the economy really is. Middle-class Americans are selling their plasma to make ends meet. Last year, people in the United States made an estimated $4.7 billion selling their plasma. And if you drive around communities, including Old People, Sarasota, You see these plasma centers everywhere. Think about that next time someone tells you this is the damned golden egg. For MacroEdge Radio, everyone, have a great evening. Good night now.